Welcome, everyone. This is Top Down with TCM. I am your host, Jason Cruz. Azaan, Weston Weinberg joined with me. We have very, very special guests today. Dan Regan, I hope I'm saying that right. Rodolfo Mendoza Jr. and Dylan Patel. Hello, guys. Thank you for joining us. All right, so this podcast is going to be a little bit different than all the other times. We have quite a few guests, and this is going to be our actual last podcast for the semester before we hand it off to the new portfolio managers. So this podcast will consist of all of us getting our input. If people don't want to speak, that's fine. If people want to speak, that's also fine. So us as hosts will be joining in on the conversation as well. So I'll introduce myself and then everyone will get a chance to introduce themselves. So a little bit about me. I am obviously in the TCM program. I am a healthcare analyst, and I am also a bond portfolio, co-portfolio manager for the bond portfolio. I'm majoring in accounting and finance. And after this is all over, I'm going to work as a public accounting at an accounting firm. And then I'll move it on to Azaan to introduce himself.
Yeah, thank you, Jason. Thank you for introducing us all. And yeah, my name is Azaan. I'm a senior as well, analytics and finance student in TCM. So I'm also a healthcare analyst, but I feel like these sector titles don't really matter because I've written reports in like every single sector. So like it doesn't matter. But also a bond PM. Bonds are cool. Don't get it twisted, Just because equity's got these crazy numbers, like doesn't mean that you can't make money with bonds, very safe, stable investment. And yeah, I do not currently have a job, unlike Jason, but I'm looking for one. So Weston, can you introduce yourself?
Yeah, thank you, Azaan. So my name is Weston Weinberg. I'm a senior at Cal State Fullerton. Last semester, I was a co-portfolio manager of the equity portfolio, along with our very own Azaan Barlis. And then after that, we decided that we were done with equity. We learned what we wanted to learn. We learned a lot, like definitely, but we thought we needed to change. So what myself, Azaan, and Jason did was we moved over to the Tcm Bond Portfolio, where we co-manage the bond portfolio together. And what I find really interesting about that is, at least about bonds, is they sort of tell the real story of what's going on with the market. By looking at interest rates and by looking at payment schedules and if certain companies default on their debts, it says a lot more about what's going on in the real economy rather than the stock market, which says something quite different than how the economy looks. And I'm very happy that I could have had this experience being in TCM and co-hosting a podcast with my boys, Azaan and Jason. And I'm very happy to have these three guests. This is very exciting for us. So I'm going to go ahead and hand it off to Dan to go ahead and introduce himself.
Hi. Hey guys, I'm Dan Regan. I am in the communication services sector in TCM, as well as I've been the assistant PM in the President Scholars portfolio for both semesters now. I just really like the idea of getting to help manage a blended portfolio that combines equity and bonds, because I've been trying to get a much more balanced view of things while I'm here, because I'm in grad school, grad student. My undergrad was not business related at all, but my grad program is in finance, and I've got one last semester coming up in the fall, and then I'm going to be done and moving on to hopefully bigger, better things, but at least going to be moving on to something where I'm earning a living, and that's going to be plenty of fun. And now I think I'll hand it off to Dylan to introduce himself.
Thanks, Dan. Hello, everyone. I'm Dylan. I'm a transfer student, or I transferred here in my junior year to Cal State Fullerton, and this is my final semester here. Last semester, I worked as an assistant portfolio manager for the bond team, and I agree 100% with what Weston said. And I think bonds are sort of easier to analyze because they accurately reflect the economy. Currently, I'm a portfolio manager for the new paper portfolio, the quantitative portfolio, and I'm also an analyst for the communication services sector. And I'll pass it on to Rodolfo.
Cool, thank you, Dylan. So my name is Adolfo Mendoza. I'm 22 years old, and I am a senior at Cal State Fullerton, and I'm a Titan Capital Management investment analyst in the consumer discretionary and consumer staple sector. And I'm also the co-portfolio manager for the derivatives portfolio. And the reason why I was the portfolio manager for derivatives because I love trading options. I have experience trading options for about 2 years. I started off trading regular stocks, but it just wasn't, I didn't kind of like, it was just too easy for me. Not easy, but I guess I love options. I love the, I guess
The risk, the complexity.
the
Speed,
challenge, the challenge it comes with, and I just love waking up every morning, looking at the market, trading some options, making some money. And it's been a great experience, and I love trading. I love everything about finance, and I'm graduating this semester, and I'm just trying to move on and find a job now.
Thank you guys for introducing yourself. So I want to keep the conversation really light, and I want to focus on really major events that we can all kind of not relate to, but understand. So I love how Rodolfo just brought up options, and I want to bring up the controversy of Robinhood. So Robinhood has made headlines this past year, mainly in regards to how their platform is sort of like gamified. So there's a story about this kid that was trading options in his portfolio, and it was like negative 700, 800,000. And he ended up killing himself because he thought he owed all this money to the brokerage or something. And he couldn't stomach the losses, and that was it. Does anyone have any strong options or strong feelings? Strong feelings about that situation, and whether or not Robinhood is a platform that is encouraging really bad behavior within finance?
I think Robinhood's a good app to start, and I believe what they're doing is cool. And I like how a lot of people our age are now investing and getting more exposure of investing and trading. But obviously, it comes with, responsibility. I feel like it's not Robinhood's fault. I think I knew what the, I think I knew what the, I think the kid knew what he was getting into, especially trading options. And I'm pretty sure he was on margin. That's why it was negative. And I think Robinhood's a good app to start. And it's definitely not an app to trade options with, in my opinion, because I've traded options on that and it's not as good as other brokerages. But I think Robinhood's a good app to start. I mean, that's where I started, and that's where I like kind of grew a passion for trading. But I mean, I think it's just Robinhood's a good app. I think it's not the kid's fault, but he just had to be more responsible, in my opinion.
But should the brokerage, step in and create some sort of like restriction on new traders to trade options of that size?
Yeah, I think that's the one thing. I agree with you. It's definitely way easier to get the ability to trade options, because I know with other brokerages like TD Ameritrade, you have to actually show proof that you have enough money to trade on margin, and you have to have a certain amount of money in your account to sell options, to write calls. And Robinhood, you can literally just go to settings and then just click level 3 options, and you can do whatever you want. So that's the one thing maybe they should change, maybe like more regulations on writing options and stuff.
Cool.
Yeah, I agree with Rodolfo. I think Robinhood, like going forward, can just put some controls in place to like kind of restrict some of the access, especially like you said, like for these larger trades. But I think overall, Robinhood has done a good job kind of informing their investors. As like most of the people that use Robinhood are somewhat novice, they're beginners. They're just getting into the stock market. So I think Robinhood is a good place to start, and they have some definitely some good learning tips on their website for investors. I think this situation is just unfortunate, and as Rodolfo said, it comes with responsibility when you're dealing with large amounts of money.
Yeah, I would agree to that too. I especially with Rodolfo's sentiment that Robinhood's a great place to start. That's also where I got my start. Didn't trade any options on it. I honestly couldn't figure out where in the settings it was to enable it for the longest time. But I mean, I have figured it out now. But they do have some kind of issue with how much information they present. Like I get push notifications for some things. One was I was looking at solar power because they always give you a free stock at the beginning if you got like a referral code. And that was my first one. I got it at $4. And this last year it went up to like 50 and it was around 40 to 50. So I was looking at a place to get in. Started to see it dipping earlier this year. Then it went down to something and then the earnings call came out and said positive earnings. I was like, okay, cool. That might be a good position to enter. What it didn't say in the little push notification was like positive earnings, but I think it was negative revenues. So they were down in like one very important measurement, but the other one was up because of, I don't know, because I haven't really looked into it since then. Point is, they're a little bit sparse for an actual investor in terms of what you need sometimes. And that's the more dangerous part where you think that you know the information, but you don't actually know the information. So if you're a new novice trader and you see, okay, Disney's got this earnings thing coming up. Okay, Disney's earnings say that they were positive. That's great. And then you invest and then you see it tank down because Disney also added a lot of debt, or like even the debt is, yeah, the extra bonds are why their earnings look positive. Actually, that's not how that works. Don't worry about that. Point is, if it was like artificially inflated earnings, but if you know the full story, you know that they aren't actually doing better.
Right. So they only provide like surface level like headline news, where a real investor should look into every facet of the company.
Exactly. And like, you know, how we use facts, and facts that gives you the distilled, most like accurate, most relevant information. Whereas Robinhood's kind of taking that and chopping half of it away and giving you like the words that it wants you to learn right away.
Right.
Am I really the only person here that actually didn't start trading with Robinhood? Like
I started on E-Trade, so
I started with Robinhood. I started on Robinhood.
Okay.
Yeah.
Where did you start?
TD Ameritrade.
Oh, okay. I mean, they're like, it's still like pretty similar. Like, it's like you meant like, oh, like I traded like, I don't know, Forex or something. I don't know.
No, of course
I
not.
had a broker when I was 7 years old.
Yeah. My dad is
Okay.
Mr. Schwab.
I'm gonna test.
I'm not like, let me preface by saying like I'm not anti-Bitcoin. Like I think it's amazing in theory and it could do a lot for like US monetary policy. Like definitely. I think there's no denying, you know, the asset that it can like bring to the United States. But what I'm having trouble dealing with is the volatility with it, where it's like you've got a guy like Elon Musk in the news recently sending out a tweet about Bitcoin, saying, oh, it's not environmentally friendly. Like Tesla, we're a green company, so we're going to stop accepting Bitcoin for his cars, after he pumped up the stock originally by saying that they'll accept Bitcoin for the cars. Like he's clearly just playing with the market and moving on to the next thing, almost like a pump and dump scheme, right? So it's like, how do you feel comfortable holding on to an asset like that? Like when you know that one person or even just a few select amount of people can have such a big influence on the price.
Yeah, that's a great question. I mean, as we've seen, the power of Elon Musk and his tweets are crazy. He moved Dogecoin as well, along with Bitcoin. But I think for me, it comes down to like risk management strategies. I only invest about 20% of my total portfolio into crypto. So I think that's helped me kind of stomach the volatility. Everyone's different, everyone's unique, and everyone has their own risk tolerances. So for example, if I ask my brother, he's fully invested in crypto. He doesn't like stocks as much as I do because, you know, it's not as much of a money-making asset like as quickly because crypto has grown exponentially. I think for me also behind it, Bitcoin is more of a store of value, but the real thing is like the blockchain technology. I think that the future implications of the blockchain technology will definitely help like they'll definitely boost innovation throughout America.
Okay, here's my thing though. If cryptocurrencies are really meant to be like transactional currencies, like dollars, right?
Yeah.
Wouldn't it inevitably stabilize at a certain point? And
Yeah.
at that point, it won't become an investment anymore.
So, okay, I'm really glad that you brought that up, like especially when it pertains to Bitcoin. I don't see it being a transactional thing. I don't see it being used anything like fiat currency in the long term.
Agree.
I believe each country is going to come out with their own digital currency. China's already doing so. I believe with Ant Financial, I believe they've gotten the ball rolling. Every country is going to do that, right? So when it comes to Bitcoin, it's more like just using it as a store of value, like you were saying earlier, Dylan. Like I think what you need to do or what it will be used for is similar to, like, let's say, gold as just an asset to base your currency off of. Like, I'm not saying that it'll go back to like the gold standard or anything like that, but I'm saying that it could be some sort of a tool that countries use to help influence monetary policy and not cause rapid inflation.
So it's like a hedge against inflation.
It could be.
Yeah, I agree. I don't think Bitcoin moving forward is going to have that transactional value, and I think it's going to be more, similar to gold in terms of the store value. But there's definitely other coins out there, and as Weston mentioned, I think overall, like within the next 10 years, countries are just going to come out with their own decentralized form of cryptocurrency, so where consumers all have the same, use the same form of crypto in terms of transactions.
Okay, so Dylan, you
Yep.
said you disclosed to us that you do have holdings within Bitcoin, right?
Correct.
And anyone who has cryptos, can speak to this as well. So my question about that is, it's basically almost impossible to value it, and it's literally the price of it's literally based off supply and demand, what someone's willing to pay for it.
Correct.
So when are you going to sell this asset, this investment, since you can't value it, is my question.
That's a good question. I mean, crypto is definitely unique in that way, in terms of it's hard to value, and there's not many fundamentals to it. It's more based on, like you said, supply and demand, and the way you really monitor, like you really perform analysis is through like technical analysis and price movements and momentum. It's not really about fundamentals or finding the correct value. So, the ceiling's super high. And we've seen that when it was back at like 4 or 5K, people didn't think it would hit 10K, or people didn't think it would reach 20K. So I don't know. It's really difficult. I wanted to get that exposure, but like I said, I didn't want to have too much exposure because I was a skeptical person towards Bitcoin myself when I first got into it, and it took some convincing to do. But yeah.
Dan or Regan, do you guys are Dan or Rodolfo, do you guys have any strong feelings about this?
I have no idea about crypto. I mean, I bought Doge just to like my degenerate
Just
side
kinda-
of like, all right, let's buy the dip and ride it and sell it. But
Yeah.
I mean, I don't know much about it to give my my opinion.
Okay. Dan, you got any thoughts?
Yeah, actually, I've got some thoughts on crypto in general. So, like looking back in history for all of finance, you see things like the efficient market hypothesis, which starts saying the things come after it make no sense, and that's not going to make any sense. That's not going to make you any money. Then eventually we're like, no, the efficient market hypothesis isn't completely true, because insider traders can make money, and at the very least that means strong firm EMH, not true.
Mhm.
Then you look at fundamental analysis and how it responds to technical analysis, where it's like, no, technical analysis, you can't make money off that. That's just, reading tea leaves, all of that. But then later on, as time has gone on, you're seeing more and more people are starting to make money off of that. And I kind of feel like cryptocurrencies are the next thing, and that the market is also starting to realize that there is some merit to it. Like when Howard Marks talked to our class, he said originally he thought cryptocurrencies were just nothing. They were going to go away. They were a fad. There was no logic to them, basically. But as time's gone on, he sees that there is some merit to cryptocurrencies, and that the investments can actually pay off, and it's not just throwing the dice at the craps table. And yeah, I feel like I don't know how to invest in cryptos in a way that I know that the price is going to go up. I do think that it's like what one of the other people on the podcast just said, I think either Dylan or Weston, how it's kind of, technical analysis driven and driven by, market flows and behaviors. And the people who know how to read that are the ones who are getting into the, like, whichever small coins like Dogecoin, or I forget the other one before Dogecoin, like Sushi Coin and stuff like that, suddenly afterwards they actually take off a bit. Oh, Ethereum is one that's also similar to Bitcoin at this point, because it's about, yeah. But they're the ones who like understand already and know how to get the good money out of the cryptocurrency, aside from, 10, 15, or not 10, 15, but 5, 10 years ago, where you had people making Bitcoin farms with all those little server rooms. And I feel like the faster that you learn how to actually make money off of these cryptocurrencies, the more you're going to be one of those people who got in early and actually made a sizable chunk off of it. And you can do with that what you will. I'm not one of those people who's like, Bitcoin is the future. It's going to be replacing all money, but I definitely think it's part of the future of finance, and it's going to be here to stay.
All right.
That's an interesting thing. Oh, sorry. Did you want to say something first?
Yeah, I'll just add something. I think also that we're seeing recently that like crypto is becoming more and more adopted by institutions. And I think I was reading the other day that like JP Morgan said they were gonna, set up a fund for crypto, and other banks as well. So
I think Goldman.
That was Morgan Stanley.
Oh, Morgan.
Oh, dang.
For the correction, Weston. But yeah, so I think as time goes on, I think more and more people will start adopting it. Yeah.
All right.
Okay.
Azaan, do you have any opinions on this?
Yeah, so it's like the more you think about, there's like a lot of opinions that like I guess like a lot of people have about like how do you value crypto, like how do you value your stocks, but like I don't want to get super complex with it, but I don't think that investing is about valuing like your security, because in stocks, yeah, you value like Snapchat or whatever, market cap is going to be 200 billion. It's at 100 billion right now, so it has so much room to grow. We're going to make a bunch of money investing in it. But like when you look at bonds, you're not really, it's a different asset class, but even though you know how much the bond is worth, you're not looking at it. It's also based on supply and demand as well, right? Whenever like a bond price or yield is basically measuring the demand. So the yield is higher whenever there's more demand, and whenever there's less demand, the price goes up. But the demand is like visibly like less. So I don't think that valuing something is like the only way to invest. And every single type of like asset class has a different like unique aspect to it. Like derivatives, like whenever you trade options, like I don't really know how options work, but I think like the main goal, you're trying to capitalize on like a movement you think might happen. It's not really like I'm valuing my option at this certain thing. It's just kind of like I see an opportunity, and this is going to help me capitalize on the opportunity. This kind of brings me into like talking about Tesla, kind of, because when in the beginning, whenever Tesla like went like up like crazy, its fundamentals were super bad. It had like PE or like price sales that were like extremely high. PEG ratios, like all the value investors were like crapping their pants, right? Like they have no idea what's going on. And it like had a resistance level where technical analysis actually like showed it did pretty well. Like technical analysis could understand that after it broke 300, it started flying. So I started thinking about it differently. Instead of how does Tesla like, how much do I value Tesla? Like, is it really this valuable? I started thinking it more about what is the market share of what Tesla provides? Like, what does your investment provide? Like, if Tesla's the only electric car manufacturer and everyone's going to use electric car, that market share is like gigantic. Like that market share is massive. It's not really about like what the numbers say on like a DCF or whatever. It's kind of more about what the company can provide like to the world, kind of. And crypto, if you look at it in terms of like what is this valued, like, oh, this is it's 60K, it's like too expensive, it's 50K, it's less expensive. It's more like what is the value of providing a worldwide global currency? And I think that it's not even close to hitting that. So that's kind of like my opinion on crypto and that stuff.
Dang. Okay,
Yeah,
I
that's
like
kind of
it.
true. I agree with you, Azan. I feel like certain different type of people have their own form of investing and how to price an asset. Like you said, derivatives. That's true.
Yeah.
Like you don't buy you buy derivatives based on the stock on the underlying asset, but you're kind of investing in that option or derivative based on what you think is gonna happen, not based on the stock.
Yeah.
Like a earnings report, you know the stock's gonna move, so you can make it a derivative to make capital and produce alpha on that stock move. So I thought that was pretty cool that you mentioned that, but I agree with you.
Yeah, yeah. It's just like what is whatever your investment, like what does it help you do? Like stocks inherently help you own a company. Like it's not really about like how much can I earn on this company because I'm going to sell it later. It helps you more like um the stocks inherently like let you own a company. So investing in Bitcoin kind of helps you own a share in a global currency. That's kind of what I think. But any differing opinions, I'm open to hear it.
No, I think you guys bring up some really good points. I agree with most of what you guys said, and Dylan especially, I agree with what you said. I like to allocate my portfolio into cryptos at least just a little bit, maybe not 20%. That's a little extreme for me, but I actually do have some assets in cryptocurrencies. And as cryptocurrencies, developed like this interest, especially within like institutions like Charles Schwab and like what was it, Morgan Stanley, I think you guys were saying. And then Tesla buying up 1.5 billion, I think it was. Then I was like, okay, maybe there's something to this. And so I put some money into it, not a crazy amount of holdings. And that whole craze and that whole adoption kind of brought me into it. So there's that. All right. And if you guys are okay with it, I'm gonna change the topic. Is that something I could do? Perfect. Okay. So we talked a little bit about this off camera, but basically what I want to bring up is the whole debate about active versus passive management and just ETFs in general. You guys know how I feel about ETFs and passive management and how fund managers have a very difficult time beating benchmarks, S&P 500, Barclays aggregate. And I just want to hear you guys' thoughts. Like, I mean, this is what we're doing, guys. Like, we're managing portfolios to beat these benchmarks, and it's really difficult for portfolio managers to do.
Well,
So, my question to you is: do you guys have strong feelings about either side?
yeah. So Jason, first, before I throw this question back at you,
Okay.
I just want to throw out here the TCM programs have been around for 7 years, 8 years, something like that, right in that time frame. Just a heads up, every single year, the TCM equity portfolio has beaten the benchmark, has generated alpha. All right, so I just want to throw that out there. But Jason, why are you so pro ETFs and you believe that indexing and passive investing is the way to go?
Because security selection hasn't been like a strong suit for what is it, retail traders. Like the stats just speak for themselves. Like professional fund managers have a hard time beating benchmarks. Like, and some, I think the majority of portfolio managers, right, they do beat the benchmark, but their fees can't cover the extra to give to back to the investor, if that makes sense. And so that's why if you're a regular retail trader, I believe you're just better off holding like a index ETF, the S&P 500.
So you're like, from your point of view, your argument isn't about what fund managers should be doing or that people shouldn't go to fund managers. It's that retail investors should be investing in ETFs rather than picking stocks. Is that right?
Yeah. Well, and then also there's a point of like, as a regular investor, like, do you really want to do all that research? Like, I mean, you guys know the tremendous amount of work that goes into security analysis. We're building DCS, we're writing reports all night. You want to do that for like 10 different stocks so that you can make a portfolio?
Well, I think it depends on your risk, how much risk do you want to put out there? You know, how much do you want to earn? Obviously, if you're like chilling, like, oh, you know what, I'm gonna put a couple grand here and then just earn 7%, right? Index, then yeah, I mean, just invest in index and ETFs, you know, why not? But if you want to take out the risk and like, you know what, I want to beat the market, and like, I think any retail trader would want to beat the market. So I don't know. I feel like it's just the way you want to invest, you know. I feel like every trader is different. In my case, I always want to beat the market. So, I mean, and the cool things about the derivatives is, I mean, if you have stock, you could write derivatives in order to protect and hedge your position. But I mean, a lot of people don't know about that and already don't want to put in the work, you know. So I feel like a lot of retail traders fail because they just they don't want to do the work and they get lazy. So, but I mean, I agree with you. Like, just invest in indexes if you just want to, you know, invest. But if you want to beat the market, and you have to
You got to put in the work. Yeah,
you know.
Yeah, exactly.
Yeah, I agree 100% with that. And I'm an avid, you know, active investor myself, like always repositioning even my own portfolio. But I think, you know, as we saw like a bunch of stimulus checks, we saw so many new investors come into the market over the past year, and a lot of that cash has gone into ETFs. Like, I was reading something earlier that the inflows for ETFs had already exceeded all of last year's, and we're only like 3-4 months, and this was only like 4 months in. So I think a lot of new investors, you know, either they don't have the time or they're not, you know, willing to put that effort into stock picking. So they've been dumping their money into ETFs.
Dan, do you have any opinions towards active versus?
Honestly, I don't 100%, but I mostly do agree with you that passive may be the way to go, because several classes I've heard, you know, it's very hard to beat the market. I even had at least one professor recommend, you know, if you're not going to be actively trading, you should just be investing in the SP, the SPY, because that's the one that's most, always has like good return out of all passive portfolios, and it's very hard for active ones to beat the market because, like you guys said, even if they do beat the market, the fees that they charge to be actively managing the portfolio can make them have lower returns to the investors from the market. And even in some of the case studies that I've had, like we did one on the blue chip fund, which was beating the market commonly, but also compared to a lot of the other ones that don't beat the market. And then there's been at least 1 or 2 other cases of active management that did not beat the market. So, okay, so fun fact, when I was first deciding what I wanted to come back to for grad school, thought about, you know, that question that you always get asked, what would you do if you won the lottery? Like, what would you do with your life? And I always had this silly answer. Well, not silly, but my answer is like, you know, I think I'd try and go back to school to learn to invest so that I could trust where my money's going, because I'd be investing it and not have someone else invest it. After,
Really good answer.
Yeah, thanks. After being in here for a while, I kind of feel like I'd just invest in a passive index. And then when I felt like the market was going to turn, I'd pull my money out. Or maybe if I want to spend more time, I would do more active investing. Like my own portfolio is actively invested. I'm not in any indexes. I might be in one, but then I thought I was in one. Then when I was looking it up for a simulated portfolio project for 541, found out that it's not an index. It's just, yeah.
Oh, okay.
So it's a good one though. But yeah, I found out, I like to do active investing, but from what I've learned, you can get pretty solid returns just doing passive investment, and the fees for passive indexes are much cheaper than the fees for mutual funds or hedge funds or any other actively managed portfolio.
Perfect.
And you
So
have to keep in mind, you'll get taxed on stocks you don't hold for the time it is, you know. So
that too. That's
keep that on mind. Yeah, in mind too. Especially like me, like I'm obviously I don't make a lot of money trading options, but obviously it hurts, you know. And I'm like, dude, I should just not even trade because, you know.
Exactly. Yeah, definitely. I think a lot of investors like don't don't go into those positions because of like the taxes on those capital gains as well.
And that's the good thing about derivatives. I mean, you got a long position, but you're like, damn, the market's gonna take a hit. You write calls, you buy some puts, and then you don't have to sell those stocks. You just make money
I
off
see.
the derivatives. Hedging.
Okay. Zahn,
Yeah.
do you have any strong feelings on this? Before I go to Weston, I feel like he's itching to say something.
Not really. I guess I mostly agree with you and Dan.
Okay.
But like you can also actively trade, but if you're an active trader, it probably makes sense to look more into like different ways of investing, like doing derivatives or maybe somehow being able to hold like some private equity or something. Because like if the market is generally efficient, you're most likely going to lose out because you're not a better investor than a lot of these, like a lot of like fund managers who went to like who've done like 20 years in like finance and like they know. But unless you do something different, like that's why crypto is like really cool too. Unless you do something different, you're probably not going to beat the market. So unless you're extremely determined and you have like alternate routes that will help you, just invest in ETFs. Yeah.
Well said. Okay.
Can I ask a question?
Go for it.
Yeah.
Open
So
panel.
I'm just wondering, like, how can we like tell the difference, between luck and skill with some of these fund managers who may have posted like great gains over the year, or
So
more in the short term?
I actually did research on this. It came from, I think, PWL Capital, where they did this thing where the only way for a fund manager to actually prove that it was their skill in stock selection that actually made the difference in beating the benchmark. They actually need a significant amount of years of 2% alpha to justify whether or not that was skill or luck. And I believe the number was 36 years. So you needed to produce 36 years of 2% alpha for that to be considered skill in excess of like the S&P 500.
That's gonna be my goal for my lifetime.
So like,
36 years, guys.
so like ARK, right? ARK made pretty big headlines. That's an actively managed ETF. That's an actively managed fund. And she's posting like 47% alpha from the benchmark or something crazy like that. But the problem is she's only been operating for like 3 to 4 years. So, is she going to average an 8% annual return over 100 years like the S&P has? I don't know. We'll see.
I don't know about you, but I'd rather be lucky than skilled. That's for sure. But I just want to like throw this out here, right? Because I didn't really get to share my thoughts. I want to hear your thoughts a little bit.
Please, yes.
So I think index funds are great for someone that doesn't know anything about investing. Index funds and ETFs. Whenever any of my friends talk to me, because I'm the one finance guy, they always talk to me like, "Hey, Weston, I want to get into investing. What should I buy?" I'm like, "All right, you're gonna buy ETFs. Get the SPY, get the SPY, put your money in that." Because I'm just thinking on the side, like, no, these guys have no shot at being in the market. They're gonna lose everything, and they're never gonna want to invest again.
Right.
Like that's just what I think naturally, because I try and think worst case scenarios rather than best case scenarios. However, for someone like us or for someone in the industry, I think for your retirement account, like Roth IRA, 401k, I think you go the passive route because that's going to be long term. It goes up and down, consistently, but over time it'll consistently be on a linear slope. So I think for retirement, you invest in what the Vanguard, VU, is that what it's called? I think it's VU.
Yeah, Vanguard's S&P 500
Yeah, you invest
ETF.
in excess, what, like 0.1% fee. It's going to move with the market. Like you should definitely do that for your retirement because I don't want anyone playing games with that. Like even if I were to be, a wealth management professional or anything like that, I would recommend putting a good portion of your wealth into one of those ETFs that moves with the market. However, the way that I see it is if you're in the industry, if you do not believe that you can beat the market, then you're in the wrong industry. Like when I'm hearing a lot of finance professionals, coming in guest speaking in our classes and talking about how, passive is the way to go. and they're portfolio managers. Like, what's coming into my mind is, how are you not confident enough in your skill set to generate alpha? But my big thing is, let's say that every single investor only invests in the S&P 500. That's only 500 companies that are able to raise capital.
Mhm.
Isn't that unfair, or isn't that wrong, that other publicly traded companies, no matter what they do, cannot get the capital to expand? Isn't that a bad thing?
I mean, but that's under the assumption that every single investor invests in like an S&P 500 index fund.
Which is,
Well, but that's what you're saying that we should be doing.
Well, it's to generate the
Yeah, I'm
most
talking-
return. Like a sensible investor should do that. But
okay.
you know, oh, sorry. Go ahead, Dan. Go ahead.
I was interrupting, but if you want to continue, you can continue.
I guess I was just gonna say, like, some train of thought. So the like basically what you're saying is everyone investing in S&P 500 would fucking break the stock market, right? Like essentially that's what would happen, and then only those 500 companies would. No, it would even stagnate.
No, I'm saying it would
because
create.
no new money's coming in
I'm saying it would create oligopoly. There are
of
only
those 500 companies.
500 companies that can raise capital.
See, but the thing is though, like, okay, I think it goes back to efficient market hypothesis, where the hypothesis is that everything is efficient, everyone knows the information, and they're going to invest in it, and everything reflects like a true price. But it's not though, and it's inefficient, and traders, they invest in many different things and have multiple different strategies, and so it's almost impossible for everyone to flood into an ETF and to decide like, hey, these 500 companies they're going to be it, and we want to make the returns of this. Like it's virtually impossible. And the S&P 500 index isn't the only one that exists. Like there's mid cap ETFs, there's small cap ETFs that are relatively like uncorrelated to the S&P 500. So if this is getting a little technical, but if you invest in like a small cap value and you think that's going to go up in the future, you can add that to a portfolio in addition to your S&P 500, and you can get the index returns of those two funds that are uncorrelated. That makes any sense.
But then,
go ahead, Dan. That was my part.
Okay, I'm not going to try and trip you up. I'm not. I'm not going to do it. This is going online.
I was mainly, like, I'd agree with what Jason said. It's not so much that I think everyone should be investing in the S&P and only the S&P. I think you as an individual will do better investing in a passive ETF than in an actively managed ETF, even if at the end of the day it's because the fees that they charge for passive ETF will be so much smaller that they won't, that the active ETF's larger fees make them go below the returns. And in a way, you are kind of betting against people in general in the market. So you're hoping that people invest in other things, or you're hoping in this case, actually, no, you'd be hoping in this case that they're investing in your thing, but by not investing in the actively managed ETF, you're hoping that people are not investing in that, or that you're just not trusting that the active managers are going to know what people are investing in, as well as the well-known S&P 500 tracks 500 most popular companies, or most efficient, most better. Let's go with most better. That sounds professional. But yeah, it's also like what Jason was getting at a while back of, like, Weston, you believe that you can actively manage a portfolio and that you can get positive alpha over your index. And that's good. But do you believe that an actively managed ETF that you find, like a randomly actively managed ETF, that they're going to be able to get positive alpha over the S&P or over any other passive portfolio index that you could see?
No.
Yeah, and that's why I understand, like, I'd rather invest passive ETF than active ETF. But at the end of the day, I'd like to trust myself, hopefully as much as you trust yourself in your active investments. And I'd rather manage my own stuff actively. But if I'm not going to be active, I want to choose a passive portfolio that does not try and beat the market because everyone makes mistakes. And I feel like, in a way, I feel like after so many times hearing it, that portfolio managers have come to this conclusion that it's okay if they make mistakes and don't beat the market, because so many don't beat the market. So it's a self-fulfilling prophecy.
Azaan, our very own Azaan, got chewed out by one of our board members.
Yeah.
Chewed. Ha!
That's
on the stock, Chewy. And mainly, I correct me if I'm wrong, but he was bashing on you for what your DCF, your inputs for it, and then also your technical analysis. Was that right?
yeah.
All right. And basically, the gist of it was like saying like, your DCF what should be more conservative, and you just like putting some random stuff in
Yeah,
there.
like my whack was off and like a couple things. Yeah.
Right. Okay. So I guess a good question to ask is like, I mean, are DCFs like a really good tool to value
Yeah.
stocks? Because I mean, every investor has their own baseline, like whack to put in, their risk-free rate to put in, their tax rate to put in. What are you guys' thoughts on that?
Dude, I'm down to go first just because like that
Go
too.
for it.
I don't
Yeah,
care about
that hit you in the
DCFs,
heart.
dude. Like DCFs really don't tell you anything. Like I don't know, like how is me knowing that like in 2017 this company purchased another company for 3.7 billion, and that's why I put this input, so then this output, like it don't matter, Like personally, like I don't there's like I don't like DCFs. Yeah.
Okay.
I'll add on to that because, I sent a report up for T-Mobile and I got kind of similar feedback from Jeff with his concerns about the DCF and ultimately the WACC being too high and like not representing the business's risks. And it's good to, keep those things in mind when we're doing the model. But ultimately, T-Mobile did get pushed through and the trade did go through. And I think it was mainly because of the narrative that I had written, not mainly because of the model. It was more about the catalysts and the fundamentals and the risks to it. And I think ultimately you can make the model say anything you want. So
Yeah.
that's just something you want to keep in mind. I could have played with the numbers and justified that, but I think the narrative is more important. And tying them together is really the thing you want to focus on.
Okay. Dan or Weston, you guys got it.
I like the DCF. It may make me an outlier, but I feel like as long as you're being smart about your inputs, then the DCF should at least give you a ballpark. I don't think it should be the only thing that you base it off of. But if I put in a stock that's worth $20, I try my best to get like the right whack down, because the whack and the terminal growth rate are huge. But I put in those two things and the $20 stock says it should be worth $8. I'm not going to look into it further. If I put it in, and this is what happened with a couple of the things that I've actually written reports on, I put in the stuff, I make sure that I kind of adjust things the right way. Like, make sure that PPE expenditures and depreciation kind of make sense going together. You can't have a company that's depreciating like 2%, but making 80% of revenue being PPE expenditures, because that really doesn't make sense. Eventually that stuff's going to go bad. And long term, those two are supposed to trend to being the same rate, because once you're mature enough, all of your PPE is replacement cost. That's a tangent. But knowing that kind of stuff and the other sanity checks allows you to give an accurate idea. And actually during the board presentation tomorrow, I'm going to very lightly, cut mostly for time, have to touch on that with why we didn't sell AT&T back in the fall, because my DCF wasn't the best for that. And now that I know it a little bit better, I feel like it helps me understand. It's more of a tool for discerning what's worth looking deeper into. That's what I'd say.
I wasn't here for your other guys' comments because I was in the restroom, but I think the DCF is very important just because if you're investing in a company, the DCF will give you the free cash flows forecasted for the upcoming years. And if that company doesn't have great potential in their free cash flows in their upcoming years, why would you invest in that company? The reason why you're investing in that company is because you're making a bet that they're going to grow and they're going to have cash on hand. What's the free cash flows? So I think it's very important, you know, like Dan said, there's been some companies like, oh, it's a good company. And then I put the numbers in, I make sure the WACC is right and the terminal growth rate. And they'll like give me like overvaluation. Oh, that's not good. Or sometimes undervaluation. Oh, it's a good company. And honestly, like I think the DCF is very important in my opinion, because I mean, I've been like listening to a bunch of like hedge fund managers, like Bill Ackman, one of my idols, and he said like free cash flows is like the main thing they look at because obviously you want to make sure this company is going to have positive free cash flows in the upcoming years.
Yeah, I think it's definitely an important tool, but I don't think the DCF should be used as like an end all be all towards like your reports. But it's it's one of the only ways that we have to value companies, like where we can input some of the like assumptions you can't input in like a PE model or a DDM model and stuff like that. So, and it's obviously widely used in the industry in a variety of sectors. So I think because of that, it's very important.
Yeah, and like, why would you invest in a company that's overvalued? You know, you're in the stock market to get a good deal on a company. You know, it's like this like cliche buy low, sell high. You know, and the DCF does a good job at doing that.
I agree.
I mean, I think like I still don't really like DCF for many situations because like I guess if you're looking at a value company, like a traditional value company, maybe like gas or oil or whatever, like there's still so many things that I think DCF work for very specific companies. They don't really work well for growth companies because you can do a multiples. Like you can still do valuation. Like I'm not saying all evaluation methods is bad, but you can do like a multiples analysis or like looking at competitors, or you can do like even precedence transactions. Like you can do different valuation methods. But DCFs don't really help you like when looking at a growth company, and they really don't help at all. Like when there's a sector rotation happening or whenever sectors are doing bad just because it's that time in the business cycle. Like when me and Jason were looking at healthcare companies and like we made some valuation models, it didn't matter that like Intuitive Surgical is like amazing. Like they were at a high, and I guess like the technical analysis term, like they were at a high and like they're just selling off now. Like they're just selling off. Like a DCF doesn't really tell you that type of stuff. I think that if you're really trying to look for a company in long term and you do a DCF, you learn a lot more about the company. And that's obviously super helpful. Like making a financial statement model is like super helpful as well. But a DCF is not, I don't really find much value in it. I don't find much value in getting told like my WACC is 1% too high, or like the beta is slightly off because like I use historical beta and like I should have just used a different number. Like it's all very it's what one of our board members would say, mental masturbation, kind of like just how I see it. Like at the end of the day, like they didn't like my beta for the Chewy report, but I used every historical way you should use to get the beta. But then eventually I just have to use a bigger number just because it's an assumption. It's like, okay, how many assumptions are in this DCF? 15? Like 15 assumptions going with all these hard numbers. Why can't I just use 3 assumptions when looking at a technical analysis? I just look at how often it's sold, how much it's traded, and like where's the resistance? Like this is less assumptions actually that go into that too. So yeah.
If
Yeah,
Jeff
I agree
sees
with you, and
this,
that's what makes you an analyst, bro. You know, you're the analyst. You're supposed to assume what you think about the company. You know.
So then, can I ask a question? So would you guys consider, having more assumptions in your DCF model to be better, or like to, help you come out with a more accurate target price, or is less better? And like will more throw off the model in some senses?
I don't know if anyone wants to go for that one.
I'm down unless Dan wants to say something.
You can go first.
I would just say like probably the least assumptions as possible. Because if you're trying to find an unbiased way to see if a company is even worth looking into, I would like to have a method where you can use the least assumptions as possible to minimize bias. Yeah, and it's hard to do that in a DCF.
Yeah, I'd agree, because the most accurate is going to come from, the least assumptions. And I was thinking maybe more data, I did run into the same beta thing that you talked about last semester. I was talking to my valuation professor about a potential like DCF model. I think it was for American Eagle. Showed him it, was walking through it. He told me, that beta that's too small for a company like American Eagle. You should bump it up to here. And I kind of trusted it. And then when I was going over it with my professor, he's like, so why did you use the beta that's higher than like the 3-year one? I was like, oh, because I talked to my valuation professor. He said this. And I'm like, oh, okay, that makes sense. But I didn't know. This semester, I might have an idea because in 523, we went over how Demoterin lists betas by industry. So the industry average beta may have been higher. And if you can't justify why returns are, or their beta has been lower, it might be the conservative thing to make it more trend with the industry beta. But when Dylan asked that question, I was like, maybe if you could add something to the DCF to have the industry beta in there so that you can compare the 3-year average. And that would give you something accurate because DCF is never going to be 100% accurate. No matter what, it's not going to tell you 100% in X amount of time, the stock price will eventually plateau at this number. But the closer that you can get to an idea of what it's going to be at, the more useful it is. And the way that you're going to get closer to the reality is less assumptions, more data.
I feel like you should put your assumptions based on your report. For example, if you think it's going to grow at a larger terminal growth rate, you put that and then you say why. Oh, why is it? Just back it up. That's the only way like I would do assumptions. And then I write in a report, well, I think this versus what the street thinks, I think this is going to be larger because, that's the only reason why I would do that. But besides that, I'd just be conservative and just go off consensus, off fact sets, kind of based estimate and just do that.
I actually agree with that. Yeah. Weston, you've been pretty quiet on this subject. Do you have any particular thoughts on DCFs? They useful? Are they not?
I mean, of course they're useful. Like when I'm like valuating a company, like the most important thing to me are the revenue drivers, which would be the catalysts as we call them. So that's the first thing that I look at to see, okay, this is a sound investment. This can drive revenues, which will in turn cause the stock price to go up, right? So that's the first thing that I look at. But I feel like at the same time, we do need that fundamental research involved with evaluating a company, like where it's like, let's use a traditional value company, like for example, right? The DCF for the most part is the end all be all because growth rates are very steady, right? So it's like, I want to know, all right, is the market undervaluing where this company's at? And I'm really relying on the fundamental data. Now, when it comes to a growth company, I'm really looking at those revenue drivers. I see, okay, they posted 35% revenue growth rate for the last 2 years. Can they replicate that again? And can that potentially even get higher with any sort of new revenue streams that they're adding in there? So especially being in the infotech, like hardware and semiconductor sector, that's definitely a big thing. Now, but when it comes to that like growth company, I don't really care if it's showing that it's undervalued. I'm more so looking at what are my assumptions and why am I making those assumptions for their revenues going to be. So let's say that I see a semiconductor company that's newer and is high growth. And let's say that it's trading at a 25% premium, right? What I do is I'd first look at the catalysts, find out exactly why I find this investment interesting and that it can maintain that growth rate. And then I'm using the fundamentals more so, as I stated before, to see if it can reach those same assumptions in the future or my forecasts in the future. And then will this company basically go bankrupt? Like, does it have enough cash flow to continue to operate and continue to grow at its current pace? So that's like really where the fundamentals come in when I'm evaluating a growth company.
Yeah,
Yeah.
I guess like I see the value of a DCF in that situation, but I guess we have like the same idea on what we're doing, but I disagree on using the DCF still, just because if we're talking about learning about the revenue drivers, we can still figure that out. I won't like keep much longer this topic. I just feel a certain way, Jeff Van Hart got me feeling a certain
I
way.
know.
But like looking at a growth company that like cash flows are not going to accurately show anything about the company. Like I understand that you can learn about the company and maybe do DCF to help you understand it more, but there's like almost no way it's going to help you value that company. Like if we're doing a valuation method, I'm not going to learn the value of this company with this DCF. I'll learn the base. Like I could just look at the Z score and see if they're going to be bankrupt or not. You know what I mean? So like I think a mix of technical analysis and looking at like competitor multiples is like a much better way to actually value the company than a DCF.
Well,
And yeah,
well, let me be clear. Like Azaan, when it came to your jury report, like I agree with you. Like that should have been a buy for the TCM equity or President Scholars portfolio. 100%. That should have been a buy. I don't like it because when you're looking at something like Chewy, it's like, okay, they have this much business here. What can their market share be? Imagine if they're able to start selling directly to veterinarians. That's another added stream that they can bring in. Like that's a huge revenue driver. And for a growth company like that, that alone is a massive reason to buy that stock, right? So the fundamentals were more so like, now I completely disagree with Jeff Van Hart's opinion on why he didn't want it based off of the fundamentals. I completely disagree with that, or Jeff's opinion. But I think his main thing, or my, like what I'd have been looking for is, why did you make those assumptions for that revenue growth rate, or for that net income, or for that gross profit? That's what really matters. Like when it comes to a growth company like Chewy, which I would buy with my own money, that's what I'd be looking for. I'd want to see I'd want to know what's your assumptions going into the future revenues.
He's sharing his actively managed tips right now, guys. I gotta listen to this.
yeah, takedowns.
But anyway, all right.
Yeah, you guys bring some interesting like ideas about DCF. Like, yeah, at the end of the day, like there's different ways to value, but yeah, maybe I'm wrong too. I've only been in TCM
I
for a
feel
year.
like Kazan, I feel like how the program invests, it's a different type of investing. Like say, every investor has their own different type of investing,
Mhm.
DCF or catalyst or like growth or like technical analysis. Maybe technical analysis is a big part of you, and that kind of gives you like a bias towards DCS. That's how I was too in the beginning.
Mhm.
I mean, like being a trader, I'm like why would you buy this stock? It's like all-time highs, or like this thing's not moving, because I would base everything on technical analysis.
Yeah.
When I was looking for stocks, I literally would not look at their cash flows or income statements. I would just look at the charts. I'm like, oh, this is a good stock. And then I look at the income statements. I'm like, oh, never mind. But I agree with all you guys. Like at some
Yeah.
point, like it's just how you use the DCF and how your assumptions and stuff.
Perfect.
I actually do have a question for you guys specifically, like as hosts.
Okay, guest host. Okay.
Yeah.
Let's hear it.
How did you guys feel when the professors, like the leaders of TCM, said, we should make this podcast an assignment for you guys, like for everyone in the class? How do you guys feel about that? Was it like awesome? We're gonna have guests, or was it more like now it's work?
I think
Let's hear what you guys think.
like so last year they actually did like a podcast type of thing too that they had to do. So like this assignment has existed last year, like for last year's TCM class.
But to answer your question, Dan, to be honest with you, yes, a little bit. It was like kind of frustrating because I was like, okay, we got to do these every week now, and we gotta schedule time. But no, getting to know you guys like on a different level, getting to speak with you guys every week and getting to meet you guys through this podcast, I really appreciate that they actually made an assignment. I got to know a lot of you guys through this podcast. Like I've never talked like one-on-one with some of you guys on the podcast. So, doing this was actually a really good experience for me. I don't know if the other two guys feel the same.
Yeah. I agree. I wanted everyone on in the first place when we first started this, and to make it mandatory made it even better.
All right, so no final questions, guys? Anything you want to discuss now?
I mean, I just have a quick question for all you guys. Like,
Yeah.
Okay.
what's like the most valuable thing you guys learned from TCM?
Okay.
That's a good question. I
Let's
think
go.
everyone should answer this one.
Yeah. This will be the closing question right here.
I can start. I think the most valuable thing was just staying connected with everyone, and like, you know, how the semester was definitely unique in the fact that, you know, we didn't get to meet in person. I don't think like we still haven't gone into the TCM room, and like everything has been done online. And so just being able to like communicate effectively, you know, get together with everyone. Everyone has busy schedules or working either full time or they're doing internships and stuff. And so just, you know, working around everyone and being able to collaborate was definitely one of the best takeaways I can say.
Okay.
That's a good answer.
For me, mine's really short. It's just having the confidence to enter the industry now, knowing that I know enough to where I won't have any sort of imposter syndrome when I
Nice.
start at a company.
Okay.
I definitely felt that too.
Yeah, I think that's a very important one too for all of us.
Yeah. Go ahead, Dan.
Yeah, I kind of want to just say the DCF to see Azaan's face when I say it, but I'm gonna broaden it
Later.
to
He legit left.
no, I'm gonna broaden it to just fundamental analysis in general, because I was
Mhm.
pretty green getting into TCM. I just got my first like finance intro course done during the application process, and now I do feel like I know the DCF almost like the back of my hand, especially for any other finance things. But I also know the other things that go into it. Like I said, the catalysts and figuring out how to incorporate information that you know fundamentally into the DCF. And I'm going to be brushing up on my technicals and like flow and momentum over the summer so that I have a much more like balanced approach. And I'm hoping that that can just really, you know, get me to have good returns consistently.
I guess I could go next. I think it was the most valuable thing I've learned from TCM, right?
Mhm.
That's what it was. I think for me, it was, I want to say I learned how a firm really works, like politically. So, you know, you got your analysts, you got your portfolio managers, and you got your like your board or whatever. And it has your reports, your ideas have to make it up through that ladder. And so that told me what maybe the finance industry was gonna be like, you know. And I don't want to say whether or not that was good or bad for me, but I think that was really valuable in learning that, and whether or not I want to do that in the future. So that was that for me.
I don't know if it's something like I learned, but something like I enjoyed or whatever. It's like I don't know. I don't want to get too deep, but like I feel like most of my friends are not very like I don't have like a bunch of friends or anything. And like most of mine are like Muslim and like I don't know, like it's just cool to interact with different people who are like in like a different world who like are all very ambitious and just like it's just like a cool experience to meet all of you guys. Like I think the best part, no matter what we learned about fundamentals or like or for me for like fundamentals or like learning about like technical stuff, it's just been cool to interact with like you guys who like are all ambitious and like it's kind of cool to like kind of find your crowd, I think. So I just enjoy that aspect. And it's like it's been like it would have been a much rougher year if I wasn't in TCM because I wouldn't have known you guys, honestly. Yeah.
That's
I
very true.
agree.
There.
Yeah. Well said.
You and
Guys,
Dylan
we
just make me feel
cannot.
this.
We still gotta hang out after TCM, guys.
Absolutely.
We have to. Yeah.
Absolutely.
Definitely.
All right. Now the man who answered the question or asked the question,
Yeah.
what's the most
I guess
valuable
for
thing
me,
you
the
learned?
most valuable thing I learned is just, I guess I could say, I can say with confidence that I'm an analyst, like investment analyst. I felt like I thought I knew so much about the industry, just trading stocks and options. And then once I joined the program, like I wasn't even close to knowing like
Yeah.
anything about this, like,
Same, yeah.
and I learned so much about myself, about investing. And this program, dude, taught me like to be dedicated, taught me to be disciplined, how to be like how to manage my time management. Honestly, if it wasn't for this program, dude, like I don't know, like I wouldn't like at school as much. Like I love this stuff, it's sick.
Yeah.
Yeah,
It's just, and I met a lot of friends too. My new homies now, we're
absolutely.
after
Yeah.
this, we're gonna party it up. We're all gonna be investment analysts at big banks and firms, balling. We go hit the club, Vegas.
I hope so.
It's just cool, I like the work ethic it comes with, and it's probably the best decision I've made in my college career for sure.
Yeah, I agree 100%.
Yeah. Same, honestly. Yeah.
Yeah. So we're all pretty grateful that, TCM as a program exists. And I think this is something that we'll remember for the rest of our lives and we'll take for the rest of our lives. I just want to thank again, Dan, Rodolfo, and Dylan for joining us on this episode of Top Down TCM. We are your hosts, Jason Cruz, Azaan Barlis, and Weston Weinberg for the final episode of this semester. Thank you for joining us, and we'll hope to see you guys next time.